Unit 13 is really the last assignment week of the course. We'll cover chapters 12 and 13. Chapter 12 is the sources of financing chapter, and chapter 13 is the planning for the harvest chapter. Any business plan should always address how do you plan to harvest the wealth or the value that you create in this business. So let's get into some charts on chapter 12 and chapter 13.
Okay, Management 308 students, we're going to cover chapter 12 today, a firm's sources of financing. This is a really good chapter. There's a lot of good practical information in here for us as entrepreneurs on how we can go about raising money for our company. So let's get started on this. When you start thinking about financing your company, you have to think about where's the money going to come from? How am I going to get the funding that I need for my company, and what kind of things do I have to think about? So here's kind of a broad way of looking at it. There are typically three broad categories of financing: spontaneous financing, external financing, and profit retention. Spontaneous financing could be the company's ability to raise cash as you go to fund investment and growth, or external financing then could be debt, or it could even be equity. And then profit retention is where I simply build up my profit to the point that I'm ready then to begin a project or to begin a growth process, and I can use that money for that. So those are kind of the three broad areas of types of financing. Let's look specifically at some of the considerations that you got to think about when you're thinking about financing your company. And I'm speaking to you today from a standpoint that most of you might at some point in time be thinking about starting a company, or getting the capital you need to get a company growing, or things like that. So let's think about some of the considerations. One of the things that will dictate what you can do about financing your capital is your economic potential. What is the company's economic potential? What can you do? Where can you grow to in terms of your company? What kind of size is the company right now, and what kind of maturity does the company have right now? Is there an established record? Has the company been around long enough to be able to predict what it's going to do in the future, at least to some extent? What types of assets does the company have that might be used for collateral? And then what are the owner's preferences for debt or equity? And this last bubble that we're looking at here, the one on the right, is really important. Most owners have some attitude toward debt and some attitude toward equity. Some owners hate debt, absolutely try to avoid it at all costs. Others use debt to try to leverage their investments, and so you have a broad range of attitudes. So a lot of what you do with your company as far as raising money will depend upon your attitude toward debt versus equity. Now, as you think about debt versus equity, you have to think about what is your potential profitability for the company. And we're going to show you in just a moment that your actual profitability is greater in a debt situation than it is in an equity situation. You have to think about your financial risk, and that's the other side of the debt equation. When you take on debt, you're taking on financial risk, and so you have to come to terms with, are you comfortable with the risk or not, and how do you mediate that risk? And then you have to look at voting control. If you're concerned about the control of your company and you don't want to share control of your company, then probably you don't want to get into an equity market. Because once I take on equity for my capital source, then I'm giving up control of my company to my other shareholders in the company. So those are kind of the trade-offs between debt and equity, and for most companies, that's the choices you have on financing your company and raising capital, and so you have to deal with those two. Now, what I want to look at right here is kind of the trade-offs between debt and equity, but I'm going to use a term here that you'll hear from time to time, and so I'm going to use it here so that you can kind of get an idea of what it means. If you think of the blue lines here as leverage bars, or as bars, that you might use like a crowbar or something, then you can get a feel for what I'm talking about. In a high equity, low debt financing situation, the crowbar is on the low side where the debt is, and on the upper side where the equity is, or where you might be holding the handle. And you can see the results of that is that the owner is going to lose some voting control. going to have to share control with other equity investors, and he's going to probably have a lower risk situation, or she's going to have a lower risk situation, and the profitability potential will be a little bit lower on the investment for the owners. And we'll look at an example here in a minute to kind of show you how that works. In the lower example down there, this is a high debt, low equity financing situation. This is what we call high leverage. When we leverage a company, when we say a company is leveraged, that means they have a lot of debt. So here in the high leverage or in the high debt, low equity situation, the owners maintain control. They don't have to worry about shareholders. Their financial risk is certainly higher because they've taken on more debt, but their potential profitability is higher too. And you say, well, how can that be? Well, let's just take a look at that and see how that might work. First of all, you got to understand these two definitions. The return on assets for any company is computed as the operating income divided by the total assets. So kind of remember that. This definition will probably pop up on an exam too, so remember this. Return on equity then becomes computed as net income divided by the owner's equity investment. And so one of the two things I'm looking at when I'm looking at debt or equity is what are my return on assets and what is my return on equity. And return on assets gives me an indication of how I'm utilizing my assets, and return on equity gives me an indication of the quality of my investment that I've made in my company. Now let's look at this example, looking at debt versus equity. In this particular situation, we are trying to raise $200,000 in capital, and we want to use that $200,000 to purchase some assets. So we've done that. We've raised $200,000, and we're going to look at two examples of how we raised it. We're going to look at the fact that we raised it with no debt and all equity, and the fact where we took half debt and half equity for the $200,000. So in the top line up there, this is no debt, all equity. So our profits for the year were $28,000 of operating profits, and then of course we had the assets that we purchased of $200,000. And so our return on assets then, when we divide the $28,000 by $200,000, becomes 14%. Now in the case of no debt, then we have to calculate our return on equity as the $28,000 divided by $200,000, and so our return on equity is the same as the return on assets, which is 14%. So that's the top line. Now let's go to the bottom line where we split debt and equity, and this time we have the same $200,000. We have the same operating profit, but now we have $100,000 of debt with an 8% interest rate, and we have $100,000 of equity. Now, the return on assets doesn't change. It's still the same in both cases. We have a 14% return on total assets. Not a bad deal, by the way. Now, let's look at the return on equity. We have to include the 8% interest in our total cost, and so now we have a $8,000. That's 8% of $100,000. So $100,000 debt. 8% of that debt has to be paid, and so that's an additional expense, and so our profits come down from $28,000 to $20,000. Now, we calculate our return on equity. We've only invested $100,000 in equity. You can see here in this little square right here. We've only invested $100,000 in equity. So now our return on equity is, even after the interest costs are included, is 20 divided by 100, which is 20%. So we've gone from a 14% return on equity to a 20% return on equity simply by leveraging our company. We leveraged up by $100,000, and that's what we call leveraging when we take on debt. If I say a company is highly leveraged, I mean that company has taken on a lot of debt. Now let's look at some sources of funds for companies, and we have equity and debt sources, and again we're looking at all the considerations an owner has to make. Certainly personal savings is a good source of the funds, and chances are you're going to always use a lot of that. Your friends and family are sources of funds. Other individual investors, we sometimes call those angels, or sources of funds. And those can be, friends and family can either be debt or equity. I can sell equity in my company and private stock and sell it to friends and family, or sell it to individual investors. Angel investors will want some equity in my company if they're going to give me some money. I can borrow money from commercial banks and from asset-based lenders, and from business suppliers. Now you say, well, how do you borrow money from business suppliers? Well, here's the way you do it. Most of the times your suppliers, particularly after you've been operating for a little while, will allow you to have a credit account, which means that you order stuff from your suppliers, they deliver it, and 30 days later you pay them. Well, in fact, what they've done is they've made you a 30-day loan. And so that's a business supplier debt situation, really is what it is. It's called accounts payable. Now, in commercial banks, it's just straight up loans. I'm taking on debt. And asset-based lenders is a little bit different. If I have to buy some heavy-duty capital equipment, such as a locomotive or an airplane or some kind of a big milling machine, then most of the times those companies that manufacture those products have a financial services branch that sets up sets up financing on their products that they're selling, so that people can afford to buy them. For instance, if I'm building a power plant, I'm a power generating facility, I'll end up probably having to purchase some big power generators from General Electric. And when I do that, General Electric has a financial services arm then that will help me set up a loan to buy that capital equipment. So they sell me the capital equipment, and they also provide me the financing for it. That's called asset-based financing or asset-based lending. There's also some government-sponsored programs that some of them serve as loans, others even serve as grants, and we'll talk about these a little bit later on. There are venture capital firms around. These are VCs, we call them. VCs typically come in on an equity basis, not on a debt basis, but they could come in on a debt basis. And they come into a company after the company has developed a product and is taking it out to the market. What VCs try to do is they try to time their entry into your company just before the big growth surge starts, and so they kind of ride that crest along, that growth crest. There's also some community-based financial institutions. These are banks or quasi-banks located primarily in economically disadvantaged locales, and they're set up by the government to support financing of businesses in those communities, not outside but inside the communities. And so you see some of those, and basically they serve as a guarantee arm to the banks who are lending money. Some large corporations will invest in small companies. Microsoft has a whole portfolio of small companies they invest in so that they can have the new product development and innovation that a lot of small companies generate that's difficult to generate in a large company, and they can use these future products in the growth of their company. In fact, there is a large networking company called, a network equipment company called Cisco Systems. Many of you are probably using their routers right now. Cisco Systems has grown their company entirely on doing that, investing in small companies. Those small companies develop some products that support the Cisco product line and strategy well. They then pay for the whole company and bring that company in as a division of Cisco and grow it. Then you can do a public sales stock. Everybody's pretty familiar with that. They're called IPOs, initial public offering. And there's both some disadvantages and advantages to selling stock to the public. So those are your sources of funds. Now let's look at whether you really want to do debt or equity financing. And here's some sources close to home. Personal savings is always a source. As a matter of fact, if you're going to go out for bank loans or other types of loans, the banker's going to want to know, have you carried your load here? Have you put some money in here, or are you taking some risk? Family and friends typically are available, and then of course credit cards. I do not advise young folks, and particularly young companies, using credit cards unless it's an absolute emergency, because it's a potential financial trap every time you start using credit cards. There's a lot of things to talk about with credit cards, and sometimes around a cup of coffee underneath a shade tree we can talk about that. Bank financing has basically three types of loans. The line of credit type loan is what we call a revolving credit agreement, but the way it works is the bank will basically finance your accounts receivable, is what it really boils down to. And they don't take possession of accounts receivable, but they use your accounts receivable as a collateral, perhaps some assets as collateral against these short-term loans. These are short-term loans. They're designed to be paid back on a revolving basis. So let's say that I have a month coming up where I know my accounts receivable are going to be slow coming in, or they're going to be bulking up for the next month. Then I will go to my banker and say, I would like to exercise my line of credit, which means that you've already got pre-approval for a line of credit. That banker approves your exercise of the line of credit or the drawdown on your credit, and you can then put that into your bank account, and you can take care of your salaries and paychecks and all those things you got to pay for in your company until the next month when the receivables come in, and now you have the cash, so you pay back the loan and you continue the operation of your business. And every time that you get in a situation where you need some cash, you can tap into that line of credit. The bank will deposit whatever you need. But you got to remember that's a revolving. It's got to be paid back very quickly. On term loans, those typically have 5 to 10 year maturities, and those are loans that you would get on, say, in some cases, equipment, furniture, things like that you would need in an office environment or production environment. Then you got mortgages, which are typically real estate or real property. Mortgages can be longer than 10 years, but typically they're 10 years max in business, and they are generally always secured by the property itself, the real property that you're buying. So mortgages primarily are aimed at real estate or real estate related type cost. Now, let's talk about bankers just for a little bit, because every one of us sit around and we scratch our head wondering about these bankers. And so here's the deal with bankers. They when you come in to negotiate a loan with a bank, the banker's concern is how much money can the bank make off of a loan with you, and then what is the likelihood that you can repay the loan. So not only do they want to know what their earnings potential is, but they want to know what is the potential for you defaulting, or what is the potential for you following through on the terms of the loan. So there's 5 C's of credit that bankers use. These are real 5 C's. If you talk to a banker, they'll tell you, yes, sir, we think we look at these things when we're considering loans. Character of the borrower, capacity of the borrower to repay the loan, the capital invested in the venture by the borrower, conditions of the industry and economy. Is it a good industry? Is it a good economy? Right now, some are good, some are not. And then is there collateral available to secure the loan? What kind of security can we get on this loan? Now you got to understand, bankers operate from the standpoint of they want zero or negative risk. They want all the risk in a loan situation in your court. Now they try to be reasonable in how they're lending the money. They try to be reasonable over whether they think you can pay it back or not. But it boils down to the fact that you're taking it on, and they're trying to be as careful as they can to preserve their capital. Now here's some questions the banker or the lender will ask, and you got to be prepared for these, because these and more will hit you every time you go in. Number 1, did the purpose and amount of the loan make sense, both for the bank and the borrower? Number 2, does the borrower have strong character and reasonable ability? That's a big issue in the banker's minds. Do you have reasonable ability? Does the loan have a certain primary source of repayment? Where's the money going to come from to repay this loan? Does the loan have a certain secondary source of repayment? Is there a backup in case the first source falls by the wayside? Can the loan be priced profitably to the customer and to the bank? And are this loan and relationship good for both the customer and the bank? You say, well, I didn't know bankers do this kind of stuff. Yeah, I guarantee they do. Bankers worry about long-term community relationships, and they certainly learn or wonder about or try to avoid situations where they deny a loan to a young startup company, and later on this company grows to become a dominant company in their area, and then they're struggling because they've made an enemy for life. Then the last thing they will think about is, from a practical standpoint, can we structure this loan in a proper way and document it in a proper way so that we don't have any issues going down the road? So these are typically the issues that a banker might ask. How much money is needed? What is the venture going to do with the money? When will the money be needed? When and how will the money be paid back? So those are always the issues that are going through a banker's mind when it comes to borrowing money or lending money. Now here's the financial information that's going to be required on your bank loan. First, you'll have to have 3 years of your company's historical statements. You know that ahead of time. You got to have your pro forma financial statements. Those are the predictions of where you're going to be in the future. Now, if I look at those 3 items right there on the screen, the first 2 items are part of your business plan. So if you have a business plan for your company and you're coming in to talk about a loan with a banker, bring that business plan with you and lay it out on the desk and show them, here's the facts right here. The other thing they're going to want is your personal financial statements, but you knew that about that ahead of time, so you're coming to this meeting with your financial statements in hand to give to them. So what do I have here when I come to the meeting? I have 2 pieces of information that's going to be provided in my company's business plan anyway, and then I have another one I can put together basically out of my company's business plan to I'm sorry, not out of the company's business plan, but out of my own personal financial statements to go with the company stuff. So basically, in this little chart right here, we've got two items that come from the company, one item that comes from me personally. I can have that in a flash. It doesn't take a lot of work. In fact, I keep that updated if I'm in the loan placing business because I know everywhere I go that's going to be asked for. Now here's an example or kind of a sample written loan request. This is a request for that Prestige and Delay are making. And by the way, you go in to apply for a loan as a startup business or a small business person, you're going to have a bunch of forms to fill out. What the banker does, they take the data that you put on those forms and then put those into a program where you get certain formats printed out when you want them. And this is a loan request format. Prestige and Delay are asking for $1 million. They're going to use the $1 million as shown in the chart right here. So this is how they plan to use the $1 million. It's a revolving line of credit, which means it's short term. It'll be paid back every month, 2 months, and then it'll be recycled again. So on January 3rd is the closing date. The term is for 12 months, so this is all short term. Rate's 8.5%, so I have to pay the interest as I go. And so then I'll take it down. This is my takedown schedule, and this is what I'm telling the person that owns the fund. This is how I plan to take it down. I'm sorry, who owns the money? He's going to lend to me. This is how I'm going to take it down. At closing, 400, March 1st, 300, June the 1st, 200. I'm going to use all this money for the cash flow operations of my company. So as a banker, I now know how much, when it's going to be repaid, and how the money plans to be used. And that's all really, really important that we do that and be open and honest with your banker so that you're not trying to pull the wool over their eyes. Now, the collateral in this situation, I have 70% of the accounts receivable under 90 days would serve as collateral, and then 50% of the current inventory would serve as collateral. So there you are in a kind of a little banknote write-up that looks pretty reasonable to me. Guarantees to be provided by Prestige and Delay, so you would insure it or provide whatever guarantees you could. The repayment schedule would involve principal and all accrued interest due on anniversary note. So at the 1 year anniversary of the note, you got to make some payments. The source of funds for repayment is the cash from operations, renewable and increase of line if growth is possible, and conversion to a 3-year note process. So the contingency source, I would sell and lease back my equipment. So the point I'm trying to make here, this is a chart in the text, and this is a very good example as a business owner how you would help alleviate some of these cash issues that small companies seem to always have. And this is a good example right here. I'm going to place a loan with an acknowledged source. Now, when we talk about interest rates, we talk about 2 or 3 things, but typically the prime rate is what you'll talk about here in the U.S. If you got an international loan or you're borrowing money from an international firm, you'll talk about the LIBOR rate, which is the London Interbank Offered Rate. And this is a published interest rate, published every week. The prime rate is a Wall Street, New York rate. It's also a public rate. It's published every week. The Wall Street Journal carries the prime interest rate data every week in its publication, and so it's really easy to figure out what the prime rate is on the day that you make your loan. Most loans that are being placed right now are based on the prime rate. So if I'm talking about I'm going to borrow $30,000, I've got to pay a +2 on the interest rate. Let me just say prime +2. Then what that means is it'll be prime rate on the day that we close the sale plus 2%. That would be the rate I would have to pay. Now, the LIBOR is similar. It primarily serves the London banks and European banks. Now, then I've got to deal with, do I want fixed interest rates or do I want floating interest rates? The fixed interest rates, although we think as people who are holding loans or paying back loans, that the fixed interest rate is a better deal. Oftentimes, the fixed interest rate is more costly for us if we're not careful in how we use it. So just remember, it's not guaranteed that the fixed interest rate is going to pay you back anything. Then there's fixed interest rate is going to be a cost advantage for us, really what we're talking about there. Let me also say that in a high risk of inflation environment, the fixed interest rate is a more cautious way to go. Now, floating interest rates means that you'll have a floating interest rate that varies around the prime rate or the LIBOR rate. So every year at a certain time, your interest rate is going to adjust. So if you're cruising along, prime rate doesn't change, then your interest rate's not going to change. But let's say you're floating along and inflation sets in and the prime rate jumps up a couple of points, then your interest rate's going to be adjusted on that anniversary date to a couple of points up. So if we have a highly varying inflation environment, then your interest rate environment on that floating loan is going to be highly varying as well. So it's primarily driven by inflation rate, or the rate of inflation, which right now everybody's saying that there's no inflation in our economy. There really is inflation in our economy. How much it is, we don't really know. But if you want to experience it, go to the grocery store and buy some food, or go to the filling station and buy some gasoline. You'll see prices have gone up. And when prices go up like that, and there's no other benefits coming out of it, there's no efficiency to gain, then we know we've got inflation. And we do have inflation. And I believe that we need to, right now, you have to be really, really aware of that as you decide what you want to do about long-term loans, long-term interest rates, and particularly investment areas as well. So just remember that the floating interest rate is probably the cheaper deal for the bank. The fixed interest rate is probably a bigger payoff for the bank. But you need to understand both of those and understand the terms when you sign them, what they mean. So when you negotiate a loan, there's going to be quite a few things you have to look at. We just kind of cycle down through these. You're going to have to decide when will the maturity date occur. So if I take out a 5-year note, this is February, so I'll add 60 months to February of this year, and that will tell me when this loan's going to mature. So a 5-year loan is a 60-month loan. Typically, the terms are expressed in months. And then I've got to look at my repayment schedule, and I can either take equal monthly or annual payments, or I can take decreasing monthly or annual payments. And the decreasing monthly or annual payments, in my opinion, are pretty good, depending upon what kind of inflation environment you're in with this equal monthly or annual payments. The bank can also impose restrictions on you as a borrower. You come into your bank, you want to borrow some money, they're going to want to look at your financial statements. They're going to look at any past loans you've had that had restrictions and salary limits. They could even put some salary limits and use restrictions on this loan. They'll look at equity requirements that they have in the loan, and do you have the right kind of equity, which means I have invested in my company, and or I'm putting some money down on this loan. Then you look at personal guarantees that the borrower might have to make. And so these are all kind of the wrap-up type activities that go on when you're placing a loan like this. And it's something you got to be very aware of, because typically the lenders like to sneak in little things here and there that's going to cost you some more money and put some more money in their pocket. And you just have to be aware of those and not be wasting money when you're doing these things. Now, let's look at asset-based lenders just for a little bit. Typically, I've already told you a little bit about them. They are your business suppliers. Well, let me back up. There's really two classifications: business suppliers and asset-based lenders. And we've talked a lot in the past about accounts payable, but accounts payable is a short-term loan by your business supplier, and that's pretty common in the business world. And you just have to manage it carefully and make sure that you're operating within whatever the financing period or financing cycle is that your customer wants to do that. Now, let's look at the asset-based lending just for a little bit. Typically on asset-based lending, the asset seller, the person who manufactured the equipment, will provide a way for you, the user, to borrow the money to buy whatever equipment we have to have. You can also lease equipment. That keeps you from having a lot of money laid out up front on the loan process. So you can lease equipment, and sometimes that's a financial advantage to do that. Now, in asset-based lending, we talked about that a little bit already. This is where I'm secure. I'm gonna get a line of credit that's secured by working capital assets. In other words, I've got some equipment in my plant. I'm going to secure that line of credit with that equipment, and then I'm going to use that money to make that line of manufacturing line or whatever it is better than what it was before. So typically it's secured by working capital assets. We've talked about that before. Working capital assets are current cash and current accounts receivable and accounts payable and current inventory. So those are all things that help define working capital. Now on factoring is something totally different. We really haven't talked much about it, but in factoring, these are companies that come around and they find a little company that's struggling, and they'll say, okay, we'll buy all of your accounts receivable, and then we will, and we'll charge you a discount for that, which means that if I pick up $100 of accounts receivable, I will apply $80 towards your payables or whatever you got to use that cash for. And then in addition to that, I'm going to charge you an interest rate. That's the way factors operate. They basically lend money to you based upon the size of your accounts receivable. And it turns out in most cases, factoring is the last thing you want to do in your company financially because it's extremely expensive to do. And it's really, in my opinion, kind of a not a very efficient way to borrow money. Sometimes you have to do it, though, because it's the only choice you have. There's also private equity investors, and we've already talked about these a little bit. Business angels. These are individuals who have made some money and they invest in others. Entrepreneurial ventures. Typically, they'll specialize in 2 or 3, and where they put their money. Informal venture capital again is private investments that some business angels make. These are business people who make quite a bit of money, and so they're willing to take on some high-risk ventures. And then you've got formal venture capitalists, or VCs we call them, and these are the venture capitalists that step in well into the cycle of the company. Well after it started, your business level might be high enough to where you can bring these VCs in. The VCs typically try to jump in toward the end of the venture cycle for the company and just before it launches off into a major growth cycle or a major sales and profit generation cycle. So there's a lot of considerations on the VCs. Typically they come in late. Typically they take control of the company. Typically they try to push the company to an IPO as quickly as possible, and then they're off and running to the next venture. The government also is involved in financing for small companies through the Small Business Administration, and the primary source of financing is through the 7A Guarantee Program. What that means is that you apply for a loan through the SBA. They will send you then to an SBA financing company, and that financing company then will set up the loan, and they will set up the interest rate according to SBA guidelines. And so basically what the SBA does then is they insure the loans to the bank. I go to the bank, borrow some money, I fill out the SBA loan, and then the SBA decides whether they're going to guarantee this loan or not. If they guarantee the loan, I take that back to the bank. They know they've got a good deal at that point in time, so they download whatever it is I'm trying to do, or they not download, but they load up and start doing whatever they got to do or plan to do with that money. Now the microloan program, I'm not that familiar with it, nor am I that familiar with the Certified Development Company, but I am familiar with the SBICs and the SBIR. The SBIC is a small business investment company, and those are companies that have been certified by the SBA to lend, make SBA loans, and so the SBA will finance those companies, or they will fund those companies. Those companies and make the loans and process the loans and handle the loans for the SBA. At that point in time, there's no bank involved. It's just these small SBICs. The Small Business Innovative Research is a really good deal. They're very hard to get, but these are grants. So if you can get an SBIR grant, that's a wonderful deal because it's a grant. It doesn't have to be paid back. You're not getting into a lot of debt. It's primarily aimed at companies or divisions of companies that are just developing new products, and this new product has some potential in certain key areas that the government's interested in, and so then they'll come in and they'll provide an SBIR grant, which allows the developer to kind of develop a prototype or develop the initial concept, and then they'll come in with a phase 2 grant where the developer can then begin to develop a little bit more mature package, and then it goes to the marketplace. On the third go around, what you have to do is have a customer lined up to buy the product, and then the SBA, I don't know if the SBA will give you some guarantees at that point in time or not, but their plan is to do this three-phase process where you get a grant to develop a product, you then get a grant to get it into a more mature product ready to go, and then you bring in big customers to buy your product. But the SBIR is a good deal. There's also a lot of state and local government assistance. Almost, particularly in our area in the state of Texas, almost every little community has what's called an economic development corporation, and these economic development corporations collect 1% or 0.5% of the local sales tax. And most of these little groups around the state are really, I say most of them, about all of them that I know, which is a handful, have quite a bit of money in the bank. And so their job is to try to attract industry to their towns or to their areas, and to come up with ways to incentivize industries to do that. And so that's a pretty important function. Okay, so anyway, the state, the EDCs will help out. That's local EDCs. There's also a state economic development fund that's pretty large, like $100 to $150 million that the governor operates. And so if you're a little bit larger company, you need, say, $50 million, and then if you make a proposal to the governor and you're providing a lot of jobs to the state and everything looks good, then you might get that $50 million. TI did that a few years ago when they were planning on developing a big new fab plant over on the borderline between Plano and Richardson, and the governor awarded $50 million for that. Most of it went to UTD for university research. Then community-based financial institutions, I think we may have already mentioned them, but these are banks and financial institutions that are set up in economically depressed areas to try to encourage and cultivate business development there. So there's a few of those around as well. You can also look at large corporations. We mentioned that a little earlier. Large corporations sometimes will invest in smaller companies, and sometimes will lend money to smaller companies. And so you just have to be in the right market and be able to pick the large corporations that might do that. And there's a few of those around. You can always sell stock, either a private placement or an IPO. Both of those are satisfactory ways to sell stock. And we'll talk more about that in Chapter 13 when we talk about the exit plans. Okay, students, that concludes Chapter 12. I hope you listened carefully. There's a lot of good stuff in this chapter. It's a fairly long chapter. So I urge you to read it carefully and think about what I've said. The exam is covered in all that we said in the lecture, the Chapter 12 exam. And so what you should do now is get ready for the exam and go take that exam and see what happens.